Hey, hi everyone, welcome to another video. So today we're going to discuss about normal distribution and standard deviations based trading strategy, and how it could be used in forecasting in trading, and how it could be used for option selling in and option buying also at intraday positional and swing trading levels, and how hedge funds use these normal distribution and standard deviations. And we also discuss what a normal distribution is, and standard deviations history also, and how successful these strategies are, and what are the returns generated from this strategy with specific examples. Okay, so normal distribution. So this is a normal distribution. So let's see. So this is a normal distribution. So what this says is, this is a phenomena that occurs in entire universe. So when you throw random things, also that random, within that randomness there is a structure or a pattern. So if you pour balls in London School of Economics, there is a thing. If you pour balls, these balls at randomly, basically, these balls will themselves arrange into this normal distribution, and even heights of human beings, lifespans of human beings, everything falls into this normal distribution, right? So, and what this says is, 60 this 34.1% is one standard deviation to the left, and 34.1% one standard deviation to the right, and 13.6 plus 34 is two standard deviations to the right. Similarly, 34.1 plus 13.6 is minus two standard deviations, and if you add 2.1 to it, it's minus three standard deviation, then point 0.1 and point 0.1. So this is what this model is. And yeah, let's get into the strategies. So this is the normal distribution channel, which basically states that 68% of the price moves within one standard deviation. Okay, so if you see this, 34 plus 34, or approximately 68% will stay within one standard deviation. So price will stay within one standard deviation 68% of the times. Okay, and price will stay with 95% within two standard deviation. Of 95% of the times within two standard deviations. So, and 99.7% within three standard deviation. So if you see this, so around 34, 34, 68, and again this is like so if you add till two standard deviations, it becomes 95. Okay, and till three standard deviations, it becomes 99.7%. So that's what it is. So this is a pattern that occurs in the universe, and from randomness a structure emerges, and this is the structure, and this is applicable to pretty much everything: heights, lifespans, and whatnot. So so this is a theory. Yeah, so what we could do from trading perspective is we can use the standard deviation zones. Okay, so to trade, and how this normal distribution can be used in trading is in intraday swing and positional trading. Bollinger Band basically does the same thing. So it plots, a average as well as one standard deviation and two standard deviation from moving average bands. So what you could use is Bollinger Bands, which plots, plus or minus two ST from moving average. Okay, and what you could do is you could, so Bollinger Band will be like this, right? So you could sell it upper band because the price has moved to 2 ST. Most likely 95% of the time it will come down. So you could sell it there, and if it is bottom 2 ST, then it will most likely go up 95% of the time. So you could buy there. So you sell at upper band and buy at lower band, exit near the opposite band. So if you sold at the upper band, you exit near the lower band. If you bought at lower band, you exit near the upper band. So, and if the price has broken the 2 SD, okay, then you see some momentum confirmation like RSI. Then based on that, you could take a breakout trade of 2 SD also. So that's how we can use this normal distribution for intraday swing and positional trading. Option sell for buying. For option sellers, what they do is they generally sell the options at one standard deviations, which is generally 30 delta. So they sell 30 delta puts and calls, and Yeah, basically the probability of the price staying within this one stays 68% of the time. And because you're collecting a premium, so it increases your chances till 84%. So if you sell sold a 30 delta put and call, your probability the price stays within is 68%, but because you collected the premium, it increases to 84%. Okay, so that's what that sellers do. They sell the 30 delta put or call, and bet on the probability as per normal distribution. Because of premium, it increases also the probability. For iron condors and for option selling of iron condors and or credit spreads or bull put spread, a bull call spread, or a bear call or bear put spread. They use a 2 ST range. So instead of the 1 ST to do option selling of iron condor or the credit spread, so you use the 2 ST range, which has a 95% probability, increasing your winning odds. Okay, but again, that has only a 95% probability, even though you are taking the 2 ST range. Fat tail events like Corona or 2009 crisis could still hit our Russian bond default. Such things, fat tail events or black swan events, they can still hit you, and you could lose money in that particular scenario. So in those cases, you need to manage risk actively and exit so that your profits are intact. Institutional use. So Black-Scholes model assumes long normal returns based on normal SD for option pricing. Hedge funds rely on value at risk models using standard deviation to set limits. 95% one day value at risk they'll take. And awareness of fat tail and curtasis risks. Like LTCM has collapsed, because of Russian default, which is a fat tail event or a black swan event. So we need to be aware of such things can happen, and yeah. So the such events have led to the enhancements like modern postmodern portfolio theory and using tail protection. So you need to have tail protection when such events happen. Risk management should be intact, and you need to cut positions quickly. Performance and real world examples to Tasty Trade, which is a company in options selling. So what they say is, if you sell one standard deviation short or put, historically the win rate is 84% win rate would be there. As I told you, 68% because of normal distribution, and due to premium, it increases to 84%. Intraday strategies, SD based mean reversion models often show 1 to 3% intraday edge per trade, depending on assets and time frame. Portfolio optimization, so the Black-Scholes framework and the evaluate risk-based risk control were considered core until 2008, but in practice, large drawdowns occurred from underestimating SD and fat tails. So LTCM failure exemplifies distortion from assuming normality when real markets exhibits extreme events. So we need to be careful about those black swan events and fat tail events, and manage risk accordingly during those events. Yeah, advantages of this normal distribution is standard deviation strategies are its systemic entry and exit zones would be there. You will use standard deviation or Bollinger bands for entry exit. A good probability is there, bias is there, unless there is an extreme move. Traffic light risk control you could put, and portfolio level where you could put. Option selling strategies benefit from implied volatility ranges. Limitations are, market can do have black swan events. It can break out the 2 ST also, and heavy tails can happen crossing 2 and 3 ST moves also. Nowadays, it's happening every 2 years, so that's a problem. Over reliance on these models will lead to collapse of the funds like LTCM, which is a hedge fund formed by Nobel Prize winners, also has collapsed. Needs precise volatility estimates and tail hedging. So yeah, the tail hedging is very important. How you could use this strategy practically is you calculate the 20-day standard deviation, define the bands 1 SD as well as 2 SD, then basically sell it near short near 2 SD plus 2 SD and buy near minus 2 SD with confirmation again with RSI and volume. So that's a buy strategy. Selling strategy is you sell the 30 delta options one standard deviation away, and adjust for volatility skew, and hedge with wings for iron condor. Okay, so for iron condor you could take the 2 SD also. Risk control size positions based on SD to limit the max loss to percentage of capital, and adjust VAR or stop loss beyond 3SD. Yeah, so if it moves beyond 3SD, we need to stop that trade. That's 99.7%. The final takeaways are this: standard deviation or normal distribution standard deviation based strategies are used for mean reversion, for option buying and option selling. Also, these strategies could be used, which is having basically a statistical edge as well as a probabilistic edge, and it's based on statistics and rule based system. They work well when they are combined with momentum and volatility filters, and when tail events or black swan events hedging is done or risk control is done properly. But yeah, nowadays this fat tail behavior is happening very often every 2 years. So we need to manage that properly, and robust risk control should be there to manage those. Yeah, so that's the uh, normal distribution standard deviation based strategies, mostly used by sellers, and we could even buyers could use it based on the pattern that occurs in the universe, from randomness to what we call a structure or a pattern, or and it happens, when you pour balls, randomly also they fall into this, in heights, weights, and lifespans, all fall into this normal distribution. So it's a naturally occurring phenomena. It applies to even standard deviation also. Price is not it's different, because price is based on humans, and human psychology also is exhibit similar behavior basically, and except for some fat tailed events and the black swan events. So yeah, so that's a strategy that could be used, and yeah, and it could be used in option buying and selling, and it has a statistical ground to it, rule based system, and edge is there in this system from both option selling and buying perspective. That's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye.